Gold, the forever currency, why every person on Earth should own it, and never let it go. Gold has been called a relic of a financial system the world left behind, and yet, right now in 2026, central banks around the world are buying gold at the fastest pace in decades. The world's most respected money managers are telling their clients to own more of it than at any time in the last 50 years. We're going to look at how gold is being used right now, in 2026, in ways that will genuinely surprise you. We're going to hear from the legends of global finance on why you should own it, and we're going to end with a number that will change how you think about money forever. By the time this video is over, you won't just understand gold. You'll understand why, of every asset on Earth, this is the one that has never, not once in all of recorded human history, gone to zero. Section 1. The Origins of Gold, the world's first currency. To understand why gold matters today, you have to understand what it has always been, and that story is older than almost anything else in human civilization. The first firm evidence of human civilization actively working with gold comes from ancient Egypt, around 3000 BC. To the Egyptians, gold wasn't just wealth, it was divine. They believed it was the flesh of the gods. The capstones of the Great Pyramids at Giza were sheathed in solid gold. King Tutankhamun's funeral mask, one of the most famous objects in human history, was crafted entirely from it. Gold was present at birth, at death, and at the highest moments of power. That changed around 600 BC in Lydia, a small but wealthy kingdom in what is now Western Turkey. King Croesus minted the world's first standardized gold coins. These coins, called staters, were revolutionary. They guaranteed weight, they guaranteed purity, and they could be used for commerce across vast distances, from Greece to Persia. Croesus had effectively invented the world's monetary system as we still recognize it today. Here's what made that moment so significant. Before coined gold, trade required you to weigh and test every piece of metal in every transaction. Coins ended that. They were a government's guarantee of value, stamped in the most trusted material humanity had ever found. Within decades, the practice spread across the ancient world. Persia adopted it, Greece adopted it, and eventually Rome transformed it into an empire-wide system. Rome's gold coin, the aureus, became the backbone of the ancient world's economy. It financed armies, paid tribute, funded architecture, and connected civilizations. By the time of Julius Caesar, Rome had even invented hydraulic gold mining methods to meet the demand. Gold wasn't just money. It was the engine of civilization. After Rome, gold's role as the foundation of European finance continued unbroken. In the Middle Ages, Italian banking families in Florence and Venice built the world's first banking system around gold lending. In 1284, Venice issued the gold ducat, a coin that remained a trusted international currency for 500 years. The dollar, by comparison, has been the world's reserve currency for less than a century. The gold standard era began formally in the 19th century. Great Britain was the first country to peg its currency to a fixed weight of gold. The United States followed, passing the Gold Standard Act in 1900, making the dollar officially redeemable in gold. Under this system, inflation was controlled, exchange rates were stable, and international trade expanded at an extraordinary pace. That system ended in 1971, when President Nixon officially closed the gold window, ending the dollar's convertibility to gold. For the first time in human history, the world's major currencies were backed by nothing but government promise. And yet, here we are in 2026, and gold is at record highs. The same metal that was discovered in prehistoric caves, the same metal that King Croesus minted into coins 2,600 years ago. Still here, still valuable, still, in the deepest sense, money. Some people think gold is a museum piece, something you look at, not something you use. Let me show you what gold actually looks like in 2026. Gold jewelry accounts for roughly half of all annual gold demand worldwide. In India and China alone, gold jewelry is not just decoration, it is a primary savings vehicle. When an Indian family buys gold jewelry for a wedding, they are not making a fashion statement, they are making an investment. They are purchasing a portable, universally recognizable store of wealth that can be liquidated anywhere in the world. The piece on your wrist is also the savings account in your safe. This is how billions of people around the world think about gold, not as an alternative investment, but as the original one. Central banks, the smart money is buying. In 2022, global central banks purchased over 1,000 tons of gold, the largest annual acquisition since 1967. They did it again in 2023, and again in 2024. Central bank gold demand has more than doubled compared to the decade-long average that preceded it. These are not casual purchases. These are sovereign nations making a deliberate, strategic decision to hold gold as a reserve asset, instead of, or, along with, U.S. Treasury bonds. China, Poland, Turkey, India, Singapore, all have been aggressively adding to their gold reserves. Why? Because gold is the one reserve asset that carries no counterparty risk. A U.S. Treasury bond depends on the United States government being able to pay its debts. Gold depends on nothing and no one. Sanctions evasion, gold's role in geopolitics. Here is something you are unlikely to see reported on mainstream financial news. Gold is currently being used as a primary mechanism for sanctioned nations to conduct international trade, and the West has found it very difficult to stop. Russia, which faces more than 16,000 Western sanctions following its invasion of Ukraine, has used its gold reserves as a critical financial lifeline. After the G7 froze $300 billion in Russian central bank assets, Russia's gold holdings, held physically, outside the international banking system, remained entirely untouchable. As gold prices surged, the value of Russia's gold reserves increased by nearly $100 billion, offsetting nearly a third of the frozen assets. Iran provides an equally striking example. After being cut off from the SWIFT banking system, Iran pivoted aggressively to gold. In 2024 alone, Iran imported over 100 tons of gold worth more than $8 billion, representing roughly 11% of the country's total imports. Hacked documents revealed that Russia settled part of a $1.75 billion deal for military drones by transferring physical gold ingots directly to Iranian accounts. No banks, no SWIFT, no dollars, just gold. Physical gold does not rely on SWIFT financial messaging or correspondent bank accounts. It cannot be frozen by executive order. It cannot be sanctioned away. When fiat currencies are cut off or fail, gold always remains a viable alternative. This is one of the most powerful demonstrations of gold's enduring monetary nature. Nations that need to trade, that need to survive, reach for gold when every other option is closed to them. Because gold is the one thing the entire world will still accept. Now let's make the case directly, not for traders, not for speculators, for everyone. Gold has no counterparty risk. Every financial asset you own, stocks, bonds, bank deposits, money market funds, exists because another party owes you something. A company owes you a share of its earnings. A bank owes you your deposit back. A government owes you principal and interest on its bonds. Gold owes you nothing and no one. It simply exists. It is inherently valuable, and it cannot default. Gold cannot be printed. Governments can print unlimited dollars. They cannot print gold. The total amount of gold ever mined in human history would fill approximately 3.5 Olympic swimming pools. That scarcity is structural. No central bank vote, no executive order, no political crisis can change how much gold exists on Earth. Gold protects against currency debasement. The U.S. national debt recently crossed $38 trillion. The government ran a budget deficit of $1.8 trillion in fiscal year 2025 alone. At some point, the only way to service that debt is to inflate it away, to print money, to devalue the dollar. When that happens, assets denominated in dollars lose purchasing power. Gold, priced in dollars, rises to reflect the dollar's decline. What Wall Street and the world's top money managers say. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund with over $120 billion under management, has been among gold's most prominent advocates. Speaking publicly on multiple occasions throughout 2025, Dalio recommended that investors allocate between 5% and 15% of their liquid net worth to gold. In his words, gold is the one asset that does very well when the typical parts of your portfolio go down, because the typical parts of your portfolio are so credit dependent. He views gold not as a speculative trade, but as a structural, permanent allocation, portfolio insurance that you hold regardless of market conditions. Dalio also cited gold's low confiscation risk as a key advantage. It is the toughest money to grab, he wrote. because it can be held in one's own secure possession, unlike all other monies that require others to make payments to give them value. But Dalio isn't alone. The biggest names on Wall Street have arrived at striking consensus, not just on price targets, but on gold's role as a core portfolio holding. Goldman Sachs has raised its 2026 gold price target to $4,900 per ounce, with an upside scenario of $5,400. The bank points to a fundamental shift. Central banks aren't merely dabbling in gold anymore, and falling real interest rates continue to reduce the cost of holding it. Goldman's research notes that gold is increasingly being treated as a strategic reserve asset, not a crisis trade. For portfolio allocation, Goldman strategists suggest that a well-diversified portfolio would carry somewhere between 10 and 15% in gold, a range that would have seemed radical just 5 years ago. JP Morgan has been even more aggressive. The bank's base case for gold is $5,055 per ounce by Q4 2026, and in February 2026, it revised its upside scenario to an extraordinary $6,300 per ounce, citing sustained central bank and institutional demand. JP Morgan has gone further still, publishing an analysis that identifies a scenario where gold reaches $8,000 to $8,500 per ounce if household gold allocations rise from their current average of roughly 3% of assets to just 4.6%. Think about what that means. One of the world's most conservative major banks is publishing an $8,000 gold scenario. Morgan Stanley set a 2026 bull case price target of $5,700 per ounce, citing strong Chinese retail demand, heightened central bank buying, and global growth concerns as reinforcing factors. Morgan Stanley's strategist Amy Gower noted that retail queues for physical gold in Australia and Europe signal a structural shift from jewelry buying to investment-grade accumulation that reflects a fundamental change in how ordinary people think about gold. The pattern across these institutions is striking. These are the most powerful financial institutions on Earth, and they are all simultaneously publishing their most bullish gold outlooks in decades. Let's talk about why gold isn't going anywhere. Gold is the ultimate inflation hedge. Inflation is the slow, silent theft of purchasing power. $1 today buys dramatically less than $1 in 1970. By contrast, gold's purchasing power over long periods has remained remarkably stable. From 1971, when Nixon ended the gold standard, through 2025, gold has appreciated more than 50 times in dollar terms. The dollar, by contrast, has lost more than 85% of its purchasing power over the same period. If you held dollars, inflation consumed most of your wealth. If you held gold, your purchasing power was preserved and then some. Gold's value is not purely monetary. Every smartphone contains gold. Every computer circuit board contains gold. Medical devices, aerospace components, satellites in orbit, all contain gold. As technology expands, industrial gold demand expands with it. The world is restructuring around gold. We are living through a once-in-a-generation shift in the global monetary order. After the US froze $300 billion in Russian assets in 2022, every major government in the world received a stark message: dollar-denominated reserves can be weaponized against you. The response has been a historic, sustained reallocation toward gold by central banks that want reserve assets no government can touch. BRICS nations, Brazil, Russia, India, China, South Africa, and their new members have explicitly discussed gold's role in a post-dollar reserve system. Gold is the one asset the entire bloc can agree on because it belongs to no nation and carries no one's political risk. The conclusion: gold is not a trade, it is a decision. So, let's bring this all together. Gold has been valued by every major civilization in recorded human history. It was the first standardized currency. It backed the British pound for centuries. It backed the US dollar for most of the 20th century. And when those anchors were cut, when the world went to pure fiat money in 1971, gold didn't disappear. It surged, it adapted, and today it is once again at the center of the world's most serious conversations about money, reserves, and financial survival. The case for owning gold is not that gold's price in dollars will go up next month. The case is deeper and more durable than any price prediction. Ray Dalio says to hold 5 to 15% of your liquid net worth in gold. Goldman Sachs says 10 to 15%. JP Morgan has published an $8,000 gold scenario. Bank of America targets $5,000. Central banks are buying at a pace not seen in half a century. Nations under sanctions are using it as their last line of financial defense. Gold is not a speculation, it is the foundation. If you don't own any gold today, the question isn't whether you should. The question is, where do you start? Physical coins, bars, and ETFs, like GLD or IAU, are multiple entry points at every level of wealth, but the starting point is the decision, the recognition that some portion of your wealth should be held in the one asset that has never, in the entire span of recorded human civilization, gone to zero. Gold is not the investment of last resort, it is the investment that was there first, and it will be there last. That is what forever currency means. If this gave you a new way of looking at gold and at money itself, please hit that like button, subscribe, and hit the notifications tab. It genuinely makes a difference for a channel like this. I'm a former stock and bond broker with over 15 years of experience. I worked for 2 top-tier investment banks on the West Coast before I retired, and I spent my career inside the very financial system we've been discussing today. What this channel is about is to give you the kind of insight and background on capital markets that most people never get access to. The stuff you learn while working on the inside. Because here's what I learned after 15 years on the desk. Finance is not as complicated or as intimidating as Wall Street wants you to believe. And the more you understand how this system actually works, the better decisions you'll make with your own money.